All right, let's get straight to our first conversation now. We have Ed Yardeni, who's the president at Yardeni Research, who's joining us now on the show. Ed, thanks a lot for being with us. You have a lot of data prints that are coming out from the US in terms of inflation. You have the RBI policy as well. But give and take everything, this has been a fabulous year for global and Indian equities. Do you see that trend continue?
Well, I had been expecting that the S&P 500 would get to 4,600 by the end of this year. It got there on July 31st, just about there. Basically 5 months ahead of schedule relative to my forecast. So now what do? Do I raise my numbers? I don't think so. I think I'm going to leave it at 4,600, which means that I think that the second half of the year is going to be more challenging than the first half of the year. The market has had an extraordinary run on a global basis in the first half. I think in the second half of the year, we got some valuation issues, especially in the U.S. market. But on top of that, I think that there's still concerns about the fragility of the banking system. We just had Moody's downgrading the banks, for example. And so I think it's going to be a tougher, more challenging environment. But I think at the end of the year, we'll be basically where we are now. And then next year, I'm much more optimistic.
Okay, Ed, good morning. So you're expecting a flattish trend from here and then pick up next year. What about the market's thesis that the Fed is more or less done? I know tonight's data on inflation is the big talking point. What is your own sense? I mean, have we turned the corner on inflation? And indeed, you feel most of these big central banks are over and done with the rate hikes?
I think that's why the stock market did so well in the first half of the year. The stock market discounts the future, it anticipates, and I think there's an increasing perception that the Fed is done or almost done. I think with the Moody's downgrading the banks, with the Fed's very own survey of bank loan officers showing that they are becoming tougher in their lending standards, I think that suggests that the Fed funds rate is restrictive enough at 5.25%, 5.5% to do the job of keeping some downward pressure on inflation. And inflation has been moderating. I think a lot of our inflation wasn't just fiscal and monetary policy. Quite a bit of it was related to the shock waves from the pandemic. And I think we're seeing inflation now moderate, abate, certainly in goods. Services has been stickier, but we know that rent inflation has come down dramatically, and that will, with a lag, be reflected in the way the CPI measures are calculated. Meanwhile, while everybody's focusing on this morning's number here in the United States, it's night now, and tomorrow morning, Thursday morning, we're at the CPI. I think just as important will be the PPI, the Producer Price Index, on Friday morning, and that's likely to show deflation. Simply because the PPI here has been very highly correlated with China's PPI, and China's experiencing some real deflation, both in the CPI and PPI, and I think that's having an impact on the rest of us.
Hi, good morning, Mr. Yardeni. Commodity prices that had cooled off quite a bit are suddenly coming back to life. Not very good news from a market like India. Now, given that sort of a backdrop, we have discussed in the past that the Chinese economy, it's an aging economy, and that's why obviously the preference is towards India. But at current juncture, given that they're talking about stimulus, pepping up that economy, do you think it gives some bit of reason for money to move towards China in comparison to India at current valuations as well?
Well, I think that on a valuation basis, China is looking more attractive, but it's more attractive for some bearish reasons. The Chinese economy was supposed to be very strong coming out of the end of the pandemic lockdowns, and instead the recovery has been pretty weak. As a matter of fact, in some ways it looks a little bit like a mild recession. The property market is still in a lot of trouble. The consumer spending has been somewhat disappointing. It's true that the oil price is up. A lot of that has to do with the Saudis cutting back on their production. I don't think it reflects that the global economy is picking up. The price of copper is kind of still stagnating. It hasn't really confirmed any real significant improvement in China's economy. And I think, meanwhile, a lot of investment capital, not financial capital, but investments in facilities and manufacturing and distribution in China from a global perspective. A lot of companies are leaving China. We have a lot of geopolitical tensions between China and the West, and companies are leaving China. I don't think that changes. And just because the government is suddenly seems to be taking a more a softer, more gentle approach to businesses, I don't think that companies really trust the government not to change its policies again. So I think China's economic outlook is deteriorating. The property bubble is bad news. The demographic profile is terrible. So I'm not optimistic about the outlook for China on a long-term basis. On a short-term basis, who knows? You know, we could have some significant fiscal and monetary stimulus that revives the stock market, but I don't think those policies are as effective as they had been in the past.
All right. Those are important cues to keep in mind from a macro perspective in China. Ed, thank you very much for joining us this morning, and we look forward to the next time that we connect. Thanks for joining in.